Have you been watching NVTS stock and wondering if this is actually the beginning of something big? Or is it just another semiconductor story that looks exciting until you look closely at the numbers? Because right now, Navitas Semiconductor is trading around $12.40 a share. And at first glance, that might look cheap compared with some of the massive AI semiconductor companies. But here's the problem. There are some serious risks with NVTS that investors absolutely cannot ignore, and one of these risks could become much more important over the next 12 to 18 months. So in this video, we're going to break down the biggest risks facing NVTS stock, what could go wrong, where I personally think the stock could be heading, and most importantly, is NVTS still a buy in 2026? Let's start with the biggest risk. Navitas has a very exciting story. The company makes gallium nitride, also known as GaN, and silicon carbide, or SiC, power semiconductors. These technologies could become increasingly important for AI data centers, high-performance computing, energy infrastructure, and other high-power applications. And that's exactly why investors are interested in NVTS. The AI boom isn't just about GPUs. All those powerful AI chips need electricity, and that electricity needs to be converted, managed, and delivered efficiently. That's where companies like Navitas could potentially benefit. But here's where things get interesting. The story is moving faster than the actual revenue. In the second quarter of 2026, Navitas generated around $10.5 million in revenue. That was an improvement from the previous quarter. But the bigger question is, can the company turn this early growth into something much larger? Because investors aren't buying NVTS simply for what the company is today. They're buying it based on what they believe the company could become. And that's a huge difference. If the AI infrastructure opportunity takes longer than expected to materialize, NVTS could remain an unprofitable growth story for much longer than investors expect. And that brings me to the second major risk. Profitability. Navitas is still losing money. The company reported a non-GAAP operating loss of roughly $11 million in the second quarter. Now, I don't automatically consider losses a disaster. A smaller semiconductor company can lose money while investing heavily in research, development, manufacturing, and customer programs. The problem is, at some point, investors need to see revenue growth catch up with those expenses. And that's the part I'm watching very closely. Because if revenue keeps growing, those losses can eventually become smaller relative to sales. But if revenue growth disappoints while expenses continue rising, that's when the stock can get punished. And there's another number investors should watch closely. Navitas is guiding for around $13.5 million of revenue in the third quarter. That's a meaningful increase. So the next earnings report could become extremely important. If Navitas hits that number and continues showing strong growth in AI infrastructure, the bullish story gets stronger. But if the company misses, investors may start asking a very uncomfortable question. Is the AI opportunity actually arriving fast enough? Now let's move to risk number 3, competition. NVTS isn't operating in an empty market. There are some very powerful semiconductor companies competing for the same long-term opportunity. And when you're a relatively small company, you don't have the same financial resources as the giants. You need your technology to win. You need customers to adopt it. And most importantly, you need those customers to scale. That's why partnerships and design wins are exciting. But personally, I don't treat every design win as guaranteed future revenue. A design win is potential. Actual revenue is what matters. And that's an important distinction for anyone investing in NVTS. Now here's where the story gets even more interesting. There is also legal and intellectual property risk. Navitas has faced patent-related litigation involving competitors, including Wolfspeed. I'm not saying this automatically destroys the investment thesis, but lawsuits create uncertainty. They can potentially increase costs, create distractions, or affect how investors value the company. And for a company that is still working toward profitability, additional uncertainty is something I would take seriously. Now let's talk about another risk that investors sometimes overlook. Dilution. Navitas has raised significant capital to strengthen its balance sheet and support future growth. And obviously, having more cash can be a good thing. A strong balance sheet gives the company more flexibility. But there is another side to the story. When companies issue additional shares, existing shareholders can face dilution. In simple terms, the company can have more cash to grow, but each existing share can represent a smaller percentage of the business. So I don't look at a capital raise as automatically good or bad. I look at what management does with that money. If the capital helps NVTS dramatically increase revenue and reach profitability faster, it could be worth it. But if the company keeps raising money because profitability keeps moving further away, that's when investors should become much more cautious. Now let's talk about the biggest opportunity. And this is the reason I'm not completely bearish on NVTS. AI data centers are consuming enormous amounts of electricity. And as AI systems become more powerful, power efficiency becomes increasingly important. That's where gallium nitride and silicon carbide technology could become extremely valuable. If Navitas can successfully establish itself as an important supplier in this market, the company's revenue opportunity could be much larger than it is today. And that's the part that makes NVTS interesting. You're not simply betting on today's revenue. You're betting on the possibility that Navitas becomes a much bigger player in the future power semiconductor market. But here's the twist. The market already knows this story. It's not a secret. Investors already know about AI. They already know about data centers. They already know about GaN and Sci-C. So the question isn't whether the story sounds good. The real question is, can Navitas execute? Can it turn these opportunities into actual revenue? Can margins improve? And can the company eventually become profitable? Because if the answer is yes, NVTS could have significant upside. But if the answer is no, the stock could disappoint investors, even if the technology itself is impressive. And now we come to the part everyone wants to know. Where could NVTS stock actually go from here? So what do I personally think about NVTS at around $12.40? I wouldn't call it a low-risk buy. I would call it a high-risk, high-potential semiconductor stock. And there's a big difference. If the AI data center opportunity develops the way bulls expect, if Navitas continues growing its high-power business, if margins improve, and if revenue starts accelerating toward meaningful profitability, I think NVTS could potentially reach the $18 to $25 range over the next couple of years. And in a much more bullish scenario, if the company dramatically exceeds expectations and becomes a major supplier in AI power infrastructure, I wouldn't completely rule out a move toward $30 or even higher. But I want to be very clear, that's the bullish scenario. It's not a guarantee. My base case view is more conservative. I think the $15 to $20 range is a more reasonable medium-term target if the company continues executing and revenue growth accelerates. But there's also a bearish scenario. If AI-related revenue ramps slower than expected, if losses remain high, if competition becomes stronger, or if legal and dilution concerns increase, NVTS could potentially fall back toward the $8 to $10 area. And that's exactly why I think investors should stop asking only one question. How high can NVTS go? The better question is, how much am I willing to lose if my thesis is wrong? Because that's what separates investing from simply chasing a stock. Personally, I like the long-term technology story. I like the exposure to AI-powered infrastructure. And I like the possibility that Navitas could become a much bigger player in power semiconductors. But at around $12.40, I would personally treat NVTS as a speculative position rather than a core holding. I would want to see several things before becoming significantly more bullish. First, consistent quarterly revenue growth. Second, improving gross margins. Third, evidence that AI infrastructure revenue is becoming a meaningful part of the business. And fourth, a clear path toward profitability. If those four things start happening together, the stock could become very interesting. But if you're buying NVTS only because you believe it will become the next NVIDIA, I would personally be very careful. Because the biggest opportunity in NVTS could also be its biggest risk. The market is pricing in a future that hasn't completely arrived yet. And now I want to know what you think. Would you buy NVTS around $12.40? Do you think this stock can reach $20? Or do you think $30 is possible? Or maybe you think the risks are simply too high right now? Let me know your NVTS price target in the comments. And if you found this analysis useful, hit the like button, subscribe to the channel, and turn on notifications. Because I'm going to keep watching NVTS closely, and the next earnings report could tell us whether this AI power story is finally turning into real numbers, or whether investors are getting ahead of themselves. Thanks for watching, and I'll see you in the next one.